ICTSI closed the first half of 2026 with headline financial results that underscore its strength. Over $1 billion in operating cash flow and almost $590 million in profit attributable to shareholders marked a period of robust earnings. Importantly, excluding changes in terminal portfolio, the company's EBITDA margin would have widened to 66.2%, a new peak for profitability. Behind these results, revenue surged 27.1% to $1.92 billion, driven by higher tariffs, a more profitable cargo mix, and growing service income beyond traditional container handling. EBITDA grew 24.3% to $1.23 billion, with consolidated net income up 22.4% to $641.4 million. Net income attributable to shareholders rose nearly 22%, as basic earnings per share climbed to 29 cents. These gains reflect both newly added operations and resilience across established terminals. While acquisitions like Durban Gateway in South Africa and Batu Ampar in Indonesia brought fresh scale, the core portfolio became more profitable. Adjusted for portfolio changes, EBITDA rose 18.2%, and margins expanded, showing pricing power and operating leverage. Revenue growth outpaced container volume. ICTSI handled 8.12 million TEUs, up 16%, but underlying volume expansion was modest. The key driver was higher revenue per TEU, rising 9.5% thanks to tariff increases, more profitable cargo mix, and new ancillary services. Currency movements also contributed, as revenues in Mexican, Australian, and Brazilian markets appreciated against the US dollar. Performance varied by region. The Americas delivered broad-based growth, with revenue up 31% amid rising trade and new shipping services. Asia remained the largest segment, benefiting from full-period contribution of Batam and better market activity. In Europe, Middle East, and Africa reported revenues soared from the addition of Durban, though underlying activity was mixed. Despite strong earnings, reported margins narrowed. EBITDA margin declined to 64.1% as expenses climbed, especially manpower costs, equipment rentals, and administrative spending. Even so, adjusted margins for core terminals improved, highlighting resilience in pricing and services. Expansion brought higher depreciation and lease costs, yet cash flow remained strong. Operating cash topped $1 billion, outpacing net income and indicating quality earnings. Significant reinvestment continued, with capital expenditures of over $320 million and substantial returns to shareholders through dividends and perpetual security redemptions. Debt increased modestly, but coverage ratios improved and refinancing risks stayed low. The company's financial flexibility remains robust, with most debt maturing after 2028 and compliance with debt covenants maintained. Looking ahead, ICTSI faces a crucial test: integrating new operations such as Durban, raising their profitability, and managing rising operating costs. If tariff and service growth moderates, margin pressure could mount. Yet for now, an expanding EBITDA margin and strong operating cash flow point to a resilient and formidable core business. ICTSI's operational and financial journey in the first half of 2026 offers both confidence and strategic insight, a highly profitable core, strategic expansion, and vigorous cash generation, all key to supporting future growth and shareholder value.